Hey everyone, so today we're taking a look at Target stock. As you can see, it fell 21% today, quite a big drop. Let's take a look at the reason for this drop. So if you're a beginner investor, you don't necessarily know too much about investing or stocks, this is going to be a great video for you because we're going to go into the very basics of why companies swing in price like this, up 20%, down 20%. It seems crazy, so let's get right into it. So obviously, for a company like Target, as you can see here, over the previous month, its price has been fairly steady, but then dropped all of a sudden 21% today. Let's look at why. So the reason is actually quite simple. Target was selling for Target's analysts, so the people, the bankers and the stock analysts predicted that this quarter or the previous quarter, Target was going to make $2.30 per share over the quarter. So over the previous 3 months, analysts were predicting Target was going to make $2.30, as you can see here, $2.30. But they actually only made $1.85 per share over the previous quarter. So they made less than what analysts were predicting. So as a result, what happens is when companies make less than what the analysts predict that they're going to make, people freak out basically. And they say, well, the analysts, all these people who are looking at this company, this big 50, 60, 70 billion dollar company, these people are looking at it and they're saying it's going to make this amount of money. Instead, it makes less, and that means it's underperforming what analysts were expecting. Analysts are usually pretty accurate, especially when it's companies of this size. Now, sometimes you'll find companies that they'll just miss by a few cents and the market will freak out and there'll be a huge sell-off for a company. But in this case, where you have a pretty big miss, it's not too uncommon to see the stock take a huge tumble. And that's what you're seeing here. So now a number to check here is that the company is selling for about 12 to 13 times earnings, which is, in the current market conditions, relatively cheap. The question you got to ask yourself is, do you think Target is a good buy at 12 or 13 times earnings? In my opinion, as a retail investor, it's not, because it's not cheap enough for me. But for some people who are into buying decent companies, and Target is, to be honest with you, not a bad company. If we look at these numbers here, Target's revenue has been going up, its operating income has been going up, net income, and most importantly, its margins have held relatively stably. So its gross margin has held at about 28% over the past 10 years, give or take. Its operating margin has been steady. Its net margin also steady. Its return on assets has been steady. So it's been doing a pretty good job at maintaining its margins, its return on capital over the course of the past 10 years. And, having about 2,000 odd stores, it is, fairly well positioned. Now, the problem with Target, and the reason probably for the earnings miss, is a little bit more to do with the actual business elements of it. So compared to, let's say, Walmart, Target is about 50% discretionary, meaning people don't need to buy the things that are there. If you look at a company like Walmart or Costco, it's a lot more consumer staple items, so things that people are going to buy almost regardless of the amount of money that they have in their pocket. But when it comes to Target, 50% of their inventory and 50% of their sales, I should say, come from discretionary items. An example could be more luxury type items that people would buy. Where staples would be things like food and deodorant, and even makeup is considered typically a staple. But discretionary items are things that people don't necessarily need to buy, but choose to buy when they have disposable income. And Target tends, compared to, let's say, Walmart or Costco, Target will tend to have more of those discretionary items. So we see in the current environment, people are saying that they don't necessarily have as much disposable income to spend because the economy is not doing so well at the consumer level. So people will withhold from spending that money on those discretionary items, and that's probably why Target is reporting that they didn't meet their earnings expectations, and they actually correspondingly lowered their expectations for future quarters. Another number to pay attention to, and this isn't on the screen here, but they also mentioned that their traffic in stores is not as good as they expected. So that's another factor, that if you're dealing with retail, obviously you need that traffic in your stores, especially as we're coming up to the Christmas season now, the end of the year. Next quarter is probably not going to be as good as was originally anticipated, and that's why they decided, hey, you know what, let's reduce our forecast in terms of our sales for next quarter. So that's the reason for the tumble. Now, if we look at a company like this company, is, for Target, it's trading at 12 or 13 times earnings. It's not, like I say, it's not a bad price. When you're looking at its 5-year revenue having grown about 6 or 7% per year over the past 5 years, that's not too bad. Same thing if we look at net income, its 5-year growth has also grown at about 6, 7, 8% over the course of the past 5 years. So it is a growing company. The question is, how much future growth is there? To be honest, that's not a number that I have for you, and I think it's actually something that's quite difficult for people to calculate. But for a company trading at 12 or 13 times earnings that's been growing at 6 or 7% per year, initially doesn't seem like too bad of a bargain. So maybe Target, for some people, would be considered a good buy at this price. Others, they might well, obviously people were panic selling, otherwise the price wouldn't have fallen. Um, and I'm sure a lot of the bigger investment corporations, they might take a look at something like Target being a decent bargain at 12 or 13 times earnings, but as a retail investor, personally, I would still stay away. So that's my opinion. Target down 21%. Difficult consumer sentiment as we navigate these more challenging economic times. Perhaps even a sign for the future if companies like Target and other similar companies start reporting decreases in same-store sales and their inventory starts piling up. Might be a sign for what's coming in terms of the next few years for our economy. So keep that in mind. I hope you enjoyed the video. Be sure to like and subscribe. Thanks.